recession 2023 might be canceled, but economists won't admit it. Here, let me show you that. So it's not a sure thing, is it? I mean, this is a Bloomberg article. Now, maybe this is the contrarian, kind of clickbait. But it's not quite so sure that we're going to have as huge of a downturn as some of these projections. Now, I'm skipping around, and it's okay because the following report on CBRE, they talk about multifamily vacancy poised to rise. Their expectation of recession, they call for a moderate recession. And, I was kind of looking for formal definitions, and the Fed's defined it, at least they have defined it before. This moderate recession means an increase in the unemployment rate by 1.25 to 2.5, which is to say that it's not a mild recession. That's a degree above, or maybe one below severe recession. So moderate is, you'll know you're in it. It's not just like, oh, is this a cool down or it's not? Because a lot of people have said, we'll be on the edge. Maybe it won't technically be a recession, but CBRE says, yeah, we'll know it. And back to Fannie Mae, but they, Fannie Mae does not really address the strong labor market as accurately or as specifically. I think that they have a tendency, to kind of downplay the labor market strength that we're seeing, and they do make a good point. Now I'll bring up the Fannie Mae back again here. If you look at the chart of, now they use, this is a Kansas City Federal Reserve labor market conditions index. So it's not like a typical unemployment or employment rate. There's probably some factors that they use and some things that they adjust. But if you look at the graph here, the labor market really peaked probably around the beginning of 2022. And it has been steadily going down. Now it's still very elevated on absolute terms, but the trend line is going down. Looking at that trend line going down, you may forget that we had really strong jobs numbers for the past couple of months and some great momentum. I think that there is a lot of things out there that show that the labor market is very strong, but it is worth thinking about the larger trends that may be happening. Maybe, we're only looking at now, and if we look in the future and look how things are going, things are sliding off. And certainly, stories about tech layoffs and, general uncertainty and a high interest rate environment would suggest that employment is going to be affected. I am continually puzzled by the strength of the labor market right now, just because of all this stuff that we're hearing about. All this thoughts of recession, all this uncertainty. I wouldn't think that people would want to hire if they were so uncertain about the economy. But hiring they are.
Well, I think the last decade, especially the last probably 3 years since COVID, it's really confusing a lot of the people that have done these projections or have kind of had it's really made a dent in conventional wisdom in terms of unemployment and the labor market and just broader macroeconomic thinking.
Mm-hmm.
Yeah, I remember taking macroeconomics, and even at that point, they were still, it was 2017. They're pushing the whole. There's an ideal level of employment or max level of employment that we could have, and you really don't want unemployment to get below 5%.
Yeah,
there's going to be chaos if that happens. And we've proved any year after that you can have 3% unemployment. The economy does okay.
Yeah.
You can have, I don't think ever will get to 2 or 1%, but now there's that combination of it. And I think we've seen a lot of it with more so through the Fed than anything, treating inflation that we've seen post-COVID like inflation that we've seen in any other cycle of the economy or any other time in the past. There's been labor shortage it's issues with labor shortages, mainly supply chain issues. And you also had an entire year of inactivity in a lot of markets where, say, if you're in Chicago or New York or LA during COVID, you weren't going to bars, you weren't going to restaurants.
Yeah.
A lot of people weren't doing anything and they were holding their money.
Yeah.
They now have that money to spend. I think there's a lot of stuff that is being factored into kind of the broader macroeconomic forecasts or the outlook moving forward. And it's using conventional wisdom from whatever happened in the 70s or the 80s or the 90s.
Yeah.
And they're not taking a look at, okay, what's going on right now? What caused the inflation that we've seen the past 2 years? Is it any different than what we have seen? Because I think it is.
Yeah. That's a good point.
I think that's why they continue to be baffled when they raise interest rates or they take certain measures, and you continue to see jobs added.
Yeah, because we're still transitioning, and you need worker, and maybe some of these workers, some of these places that are hiring, maybe it's a bar or a restaurant or a retailer. They are a lot of service industry jobs are maybe less connected to interest rate hikes than they are to really consumer confidence.
Right.
And for the past maybe month or 2 or 3, I don't know, things have slightly improved when it comes to consumer confidence and credit. Now we're still at a worrying spot when it comes to consumer credit. Like we've got a little too much of it. Maybe we got a little too less savings than we should have. Maybe, but things aren't continuing to crash. Now, just to bring up this chart again, it's a question of, is this gonna, there's a steep fall off from 2007 to 2010 in the employment numbers. But if you look back to 2000 to 2003, there was a little bit more of a mild. And so what kind of trajectory is this going to take? And I do think, you talked about the last 10 years and the assumptions. I think, since this low point, since 2010, we've, or really 2008, we've had such a pessimistic view of jobs, and that's really crept into people's psychology and the way that they understand how the economy works. It has certainly shaped forecasts, and I am not going to say that things are going to be better, but I think that there's a lot less certainty, and in this case, uncertainty may be a little bit better when the alternative is a certain doom. But that's just my own take.
And I can only speak to what our line of work is, what we're seeing internally. But when you see massive expense growth in areas that you can't necessarily control, right? You've seen insurance payments go up, or you've seen payroll go up because the hourly wage that maybe a maintenance tech or a property manager, whatever it is, it's gone up because that's just what the market is right now.
Yeah.
It hasn't necessarily led to, okay, we got to lay off or we got to get rid of people, but it's definitely led to, okay, do we need to change our assumptions moving forward from an underwriting perspective?
Yeah.
Is this just the new reality? But also, let's take a deeper look inside as to how are we spending our money, and is it the most effective way? It's causing a pause. It's causing some time for reflection.
Yeah.
I have no reason to believe that that's not going on in every other financial decision-making realm of any other company.
Yeah.
So how much of this is recession versus people saying, okay, we had to ramp up costs, we had to ramp up whatever from 2020, 2021 and 2022 to get back to where we were had COVID not happened. Now we need to make sense of where we're at.
Yeah.